This chart is anonymized. It's based on our research. It highlights how vast and differentiated the direct lending landscape is. At one point, we tracked or looked at over 300 different direct lending platforms at Cliffwater within our research team. So this chart doesn't show all the lenders, it's just a sample. But not all direct lenders are of institutional quality. We at Cliffwater have a deep history of analyzing and assessing managers based on their focus and their track record. So here, what we're seeing is the y-axis represents what share of the direct lending deals are comprised of, PE-backed deals versus non-sponsored loans, while the x-axis graph shows the average EBITDA size of the portfolio. So what this means is not all direct lenders are created equally. Some focus on, upper middle market, some focus on lower middle market, some lend across the size spectrum. The size of the bubbles implies how big their AUM is, right? So we've got small platforms and big platforms. Some focus on very middle of the fairway deals that are very safe and have a lower yield and a lower risk of default, while some managers may choose more opportunistic investment strategies and may move up the yield spectrum and lend to riskier borrowers in tougher sectors. So it's always important to understand the manager's strategy and who they compete with. Moving to slide 14. So at Cliffwater, we have an advisory business that invests across a lot of different alternatives. But as we assess the investment opportunities that are out there, we continue to find private credit super attractive, which you can see by this slide. First, you can see looking at the x-axis that private credit has a lower expected risk relative to other alternatives. This is because the assets have low volatility in terms of the movements in their underlying values. Private credit loans are more quarterly, right? These third-party valuation firms are doing a bottom-up approach. But given the resilience of first lien loans, you often don't see them get marked down materially unless they're impaired. And so in general, it's a pretty steady and low volatility asset class. On the y-axis, you see expected return. Clearly, private debt on an unlevered basis isn't the highest paying asset class, but with one turn of leverage on a portfolio on a private debt fund in the form of a private fund or a BDC or an SMA, it produces pretty attractive returns in the high single digit to low double digit area. Now, to keep this all balanced, of course, private debt has a few drawbacks relative to some of these other asset classes, and that's liquidity. Investors in the asset class are signing up for a longer term hold. These assets are illiquid in nature. It doesn't offer investors the ability to move in and out. Investors can certainly buy publicly traded BDCs. You may have seen some of those on the stock exchanges, and those certainly are liquid, but they come with a much bigger expected risk because they're equity. They can trade down very volatily. So moving to slide 15. So given the low volatility and the attractive returns, this direct lending asset class has clearly one of the highest Sharpe ratios in the industry. We discussed this earlier, but this chart highlights all the attributes plus how correlated the asset class is to stocks. When you compare our CDLI index to other benchmarks in real estate or the high yield or investment grade bond market, it looks pretty attractive. Now, equity certainly produces higher returns, as you would expect, but it also has a much higher variability of returns and more aggressive downside risk. And so we feel really good about adding direct lending strategies to a client's portfolio, and that's across economic cycles. So we tend to call this the all-weather asset class. Moving to slide 16. This is just to highlight, a lot of our clients that we work with have 60-40 portfolios, right? Equities and bonds. And what we like to highlight here is if these investors were to reallocate some of their bond exposure into private credit, it certainly increases the expected return of their portfolio while mitigating, clearly, interest rate risk. Typically, you would expect investment grade bond funds to have less downside risk in a normal cycle. But in the current inflationary environment, with the rapid rate increases we've seen, bonds have been positively correlated with equities this year, which has resulted in them getting hit pretty hard in the last 12 months. So 60-40 portfolios have been producing negative returns year to date. It's been a tough year. Folks that have moved into private credit have been pretty happy they did it because as interest rates have moved higher, a lot of managers have increased their dividends. A lot of direct lending managers have increased their dividends, and they're paying unprecedented returns in the current market. Now, lastly, moving to slide 17. I'm not going to spend a lot of time on this chart because this is the last one, and I want to be able to answer any questions that you have. But we talked a little bit about our CDLI index. We also have something called the CDLI-S index, which is the senior index. Now, this just shows managers that do just first lien risk, first lien investing only. As you can see, if you select managers that just do first lien, the yield on the portfolio is on average about 75 to 100 basis points lower, but the realized loss rate is also 75 to 100 basis points lower. And so you may often end up in the same place in terms of your returns, regardless of which portfolio you choose. This again is because junior capital has a much higher chance of loss if credit suffers default implications. But even though direct lending involves lending to smaller businesses, it continues to produce much lower losses than what you're seeing in the high yield bond index. So that's just a quick overview of the asset class.